All right, I got a $906,000 portfolio generating $11,000 a month in income. Today, I'll be going through exactly what I do with every single paycheck to make sure I can keep building up this portfolio, keep getting more and more every month, and not fall into debt. And before we start, remember this is not financial advice. Do your own due diligence, do your own research, because remember, I'm just a guy on YouTube. Don't listen to a word I say. And we're back. All right. So remember, money disappears without structure. So today we are going through that structure. Here are the topics. We'll be going through a paycheck, the minimums, the living costs, debt and emergency, and TFSA, the greatest gift to Canadians for building wealth. Step one, protect your baseline minimum payments. Every minimum payment gets covered automatically on all debts and bills. Credit protection, protect your credit score by never missing a payment deadline. All right. Let's dive into that part. I overpay all my credit cards. I used to have 40K in debt when I was younger. That made me just super debt adverse. So now I always overpay my credit cards. If I do a large purchase, I pay it off immediately. Now that's not doable for everybody. I definitely didn't start that way. I started with just doing the minimum payments, and then I started using excess cash to pay down the debt. So you got to start somewhere. That's where I started. But now I'm at the point where if I buy something for a couple grand, I put a couple grand on it immediately. I never have debt. It's always at a negative balance most of the time. So stability first. This isn't about progress yet. It's about maintaining financial stability. It's about building those habits, making sure when you buy something, you pay it off right away. Make sure you at least cover your minimum payments. Now, automation removes emotion. What does that mean? So all your bills are auto paid if they can be auto paid. Your Netflix subscription, your car insurance, anything that can be automated automatically gets paid without you thinking about it. Savings auto transferred. I never have to do this, but I know a lot of people do actually need to do this if they have a really hard time not spending their cash. Once it hits your checking, make sure it gets moved somewhere else. It gets put into an investment account, gets put into your savings, somewhere where you can't touch it if you have that bad habit. Then debt, auto paid. Kind of just talked about this. Extra debt payments happen automatically. Step two, fund daily living. After minimums, I fund normal life. This money sits in my checking account with a buffer. This is not an emergency fund. It's just removing daily friction so you can focus on bigger financial goals. Okay, I'm going to talk about this a little bit. When I was in debt, I just had this dream of always having $10,000 in my checking. That was a number. I started with having $100 in my checking to 1,000 to 5,000. Now that I'm doing quite well in life, I still have this habit of always wanting to have $10,000 sitting in my checking. That was my number. I think if you're just starting, find your number. What's that number where if you just have it sitting there, kind of just alleviates stress. So for me, it's 10,000. So after mortgage or rent, groceries, utilities, insurance, transportation, after you've invested, after you've paid down your debt, what number do you build to in your checking? I highly suggest is having $1,000 just sitting there if you can get there. This is not an emergency fund. This is just a buffer between you and whatever you need to purchase. And then as you get more successful, because you will get more successful if you're watching this, I believe in you and I trust you can do it. Build up to that number in your head. Some people, it's higher than what I have or lower, whatever you're comfortable with. Mortgage or rent, you gotta make sure these things are paid off. This is under the need category, which is 30%. Savings is 20. But realistically, I have this at 30% to be easier on people. But when I was paying off debt, needs was whatever that percentage was. And then savings and paying off debt was the other percentage. I didn't really do anything for wants. All I did was I had a decent internet connection. I'm kind of a nerd. I just played my video game that I played that's free using my internet connection. And that's where I got entertainment. I didn't go out for fancy dinners. I didn't spend any money. So while I was paying off my debt, I just played my video game to relax and it cost me nothing. Temporary thing that I was doing to just stress relief and it cost me no money. Mortgage or rent, groceries, here's how I approach it. So full transparency, I do not have a mortgage or rent anymore. Used to rent, used to have a mortgage, I have none now. Groceries, I do spend quite a bit on. Utilities, all my utilities, this is back to the credit card thing, and this is where I'm at now, is paid off a year in advance. So I'm in British Columbia, my hydro bill, my gas bill, all that stuff. I get a bill every month. It's all negative because I just throw a bunch of money on it because I don't want to look at it. I really hate bills. Insurance, same thing. Transportation. So I know when my house insurance, my utility bill, property tax, and all that stuff is coming up every year. So near the end of the year, I start just pulling together some cash ready to pay off that bill. let's just say habit I have. So if you're someone in a similar situation, the last 3 months of the year, you'll know kind of what the bill you have. Start setting aside some cash. I know a lot of people say stay invested in the market at all time. Me personally, I don't really care to be invested all the time. I don't mind holding a lot of cash. I like peace of mind over staying invested. I put aside that cash so when the insurance bills come, I can pay it off. Same with the, car insurance. I can pay that off right away. I have that money sitting there. I don't have to do anything. Gas and what other regular food. That's part of my checking. That's why I have that $10,000. I never look at gas prices are crazy. If you guys are watching this is Friday. I'm filming this March 27th. I don't look at gas prices. I don't look at how much I'm spending on groceries because I always just keep myself topped up at $10,000. I do not think about that stuff. It's gas I can't control, so I don't get too stressed out about it. And groceries, I tend to just shop at Costco or Walmart and I know what I need to buy. So I tend not to overbuy anyways because I kind of just eat the same foods every week and my kids eat their same foods. So just out of habit, I don't overspend there as well. You'll notice a lot of what I'm doing. I'm kind of working off of healthy habits. I don't have this strict rule set that I'm listening to. Paying off debt, covering all my expenses immediately or in advance. But I built up to that because I don't want you guys thinking, oh, I can't do that. Well, you probably can't right now. I couldn't. When I started, I built up into these habits. All right. Step 3, crushing high interest debt. Anything with double digits, pay that off. That's often credit card debt. So get that done right away. That's what brings me back again to why I didn't have a lot of wants when I was paying off debt. It was just, what do I need to pay off to survive? The rest went towards paying off the debt. It was that credit card debt. So I essentially just locked myself in a room for months and months, said yes to every marketing contract. If someone said $500, $1,000, $3,000, I just said yes, 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 yes. Worked for 18 hours a day, slept, woke up, rinsed it and repeated, paid off all that high interest debt, and just kept working my way down from highest debt interest debt to lowest interest debt. That's what I did. I just did it until it was gone. I had no life. And like I said, when I want to relax, I just played a video game for a little bit. That's all I did until I paid it off. I highly suggest just doing that, suffering and getting it done if you're someone in debt. Just suffer for a bit and get it done with because you'll feel so much better when you start seeing your debt reduce. This is a little graph showing credit card interest versus market return. You can check it out yourself when you download this PDF. Debt plus emergency fund together. I get this a lot. Build an emergency fund while paying down debt. Yes, you absolutely have to. They have to work together. So what happens is when you're paying down debt, if something happens, you'll just fall more into debt. So I use more or less an 80-20% rule. 80% of income that I had left over after my basic needs were met, 80% went onto the debt, 20% went to an emergency fund. So if I had $1,000, I put 900 into the emergency fund, 10 into my checkings. That's kind of how I went. Checking and emergency fund were kind of blended at this point. Because imagine if you're paying on debt, your car breaks down and you have no emergency fund and nothing in your checkings. You then have to go into more debt, right? You just don't want to fall back into the cycle. All right, emergency fund targets, initial target $1,000 to $2,000. I think this is doable regardless of your income. Just get to this number. You will feel better once you get to this number. Intermediate goal, 1 month of expenses. Full goal, 3 to 6 months of expenses. This can take a while depending on how much debt you're in, how much income you make, but just make this your goal. An easy way to get to your goal quicker, reduce your expenses. 3 to 6 months of expenses. Now there's stuff you can't reduce. You can't reduce rent. Some of you just need a car to get to work. So you're stuck with a car. You're stuck having to pay a ton of gas. You're stuck with stuff. And, we can get into another video about how to increase your income. But for the sake of today, the only takeaway I can give you is like when I trap myself in a room, when I just spent $10 a month extra on a better internet connection so I could play my online video game and have some fun that way. Find a low-cost way to get some enjoyment in your life and then cut down all your other expenses. So no more fancy dinners, no more anything, no more spending a ton of money to get some excitement. Just find some really cheap way of getting some happiness in your life and then do that. And all your other money gets dumped into paying down the debt and emergency fund, right? That's what you should be doing. Build the investing habit. All right. Now, this is the other question I get a lot. Should I invest while I'm building my emergency fund and paying down debt? Yes, I did. So very, very little. I was still investing in ETFs. I was still investing at that time, I was investing in a lot of Canadian banks. So you can still do that. I just really, really reduced it. But what I was really trying to do was build the investing habit. I have a habit. A lot of people in the $1 million club know about this, where every Friday I buy no matter what, right? So every Friday I buy a simple cover call type index fund or just a regular old growth index fund. Or if I have my eye on something and it's dropped in price, I buy that. Do that every Friday. I was even doing that when I was in debt. I just had that healthy habit. Except spending thousands like I do now, I spent 25 bucks instead or $10. I spent way, way less than I did now just to build that habit. Because I promise you, if you're watching this video, you will get out of debt, you will start building wealth, and you will want to have that healthy habit of investing into quality ETFs or stocks. All right. Step 4, TFSA. You're out of debt. You're going to start scaling this up. And if you are investing your $25, start in your TFSA. Everyone should start here because want why? All investment gains and dividends and interest are tax-free inside your TFSA. And unlike your RRSP, you can withdraw your TFSA funds anytime without tax penalties, maintaining flexibilities. And for younger Canadians or those in lower tax brackets, TFSA typically beats the RRSP for building initial wealth. TFSA, that's where I started. It's the best account, in my opinion, for most Canadians. Here's a little chart showing how much money you can make. Like I said, you can see it yourself. We're not going to break that down. Boring compounds. Do not mess around. Do not buy penny stocks. Do not try to get rich quick. When you're paying down your debt, you're building your emergency fund, or even if when you're done all that, you want to build real wealth, stick to boring ETFs. Let's go back to my portfolio. My portfolio is a good example of what to buy and what not to buy. So if you're into income, you want to build more income, I just stick with HYLD, which is the S&P 500. My non-reg, I stick with HDIV, which is tech and the Canadian market in my TFSA. And then in my RRSP, I can hold US listed funds in there with tax benefits. I hold TSPY, which is the S&P 500 with income on top. Only because I'm getting closer to retirement, I'm transitioning into more of an income-focused portfolio. So HYLD, HDIV, and TSPY. That covers my TFSA, my non-reg, and my RRSP. But they're all three the most boring ETFs that you can pick for covered call investing. Then, if I didn't want to do that, I want to focus purely on growth, maybe I'm a younger investor, HYLD would just be a VFV. Same with HDIV, a VFV or an XIC and VIV, which is Canada and the US. And then TSPY would simply be SPY, SPY, or VOO, which is just the SP 500 without the covered call income. That's it. I would never do something like Gary Gill Bitcoin, which is actually just MSTR, MSTE. It's a crypto ETF. Too high risk for newer investors. Stick to these fundamentals, TSPY, HYLD, HDIV, these boring covered call index investments that appreciate at 8 to 10% every year with distributions put back in, or if they're growth, 8 to 10% every year, just naturally. Stick to that. Boring gets you rich. That's what I've learned. Try not to be exciting. Don't go chasing trends. Don't try to be the next Warren Buffett. Just try to generate more income in your life. Make sure you have no debt so then you have more money to invest and invest in boring things that are too volatile. Oh, yeah, long-term, low cost. So yeah, most of these have lower costs. Covered calls have higher costs because they have more management, and hold for a year. Hold for years. All right. Now for the RSP strategy, I mentioned before, I hold T-SPY from Tap Alpha there because it waives the 15% withholding tax on US dividends. So I hold all my US stocks typically in my RSP. I hold T-SPY only because it's basically just the US market. What we've covered calls is boring. It's beautiful. That's why I hold it in my RRSP. Now, if you have employer match, contribute mandatory. Contribute to your RSP if you're in that position because it's essentially just free money. It's tax deferred growth and higher income advantage. So I love the RRSP now. I did not like it when I was in debt, did not like it when I had lower income. I was all about a TFSA. But now I use it as my tax deferral engine. Tax deferral first, investing second. So it just for me to lower my tax rate every year. Here's a graph showing how much you save on taxes depending on your income bracket. I'm in this higher income bracket here. So there's plenty of tax advantages because whatever I contribute gets deducted from my overall income that year. So I pay less taxes. But when you withdraw from your RSP, you do pay taxes on it then, unlike your TFSA, which you never pay taxes on, but it's not tax deferred, right? So some give and some take on both. Pros and cons. Now, low interest debt strategy. So for lower interest debt like mortgages, I'm comfortable and paying at the same time once a high interest debt is gone. Long-term math often favors investing when debt rates are low. So basically, a lot of people ask me, should I pay off my house or invest instead? You can just do both. So I was still investing when I had a mortgage. It's not that big of a difference. I'm really more concerned about high interest debt that has no benefit. Owning a home, you're paying down your mortgage. There's also capital appreciation on your property. It's all good. It's just another investment. When you're paying off your mortgage, paying into that investment, whatever you've left over, pay into a stock market investment, you just have two investments. You're good. Whatever you can afford, do that. There's more information here and go from there. So multiple income streams. This is what I'm huge on now. I'm all about building income streams. So in 2026, relying on one income stream is risky. Even a few $100s extra per month accelerates everything in your financial system. Side income creates breathing room and speeds up every goal. I have to create more content on this. Like, I think this is the hack not a lot of people think about. Side income, freelance work in your field of expertise. Gosh, I can't talk. Freelance projects, so contract work, dividend income, and online businesses. Okay, not everyone can do contract work, freelancing, depending on what their skill set is. I get that. But for me, side income is, do you have a passion or a hobby that you are exceptionally good at, that you care a lot about? Create a YouTube channel about it. I guarantee you somebody else cares about it. You can start getting some YouTube ad revenue, start building some income there slowly over years. If you're a skilled baker, start a Shopify site or sell your baked goods on Facebook Marketplace. These little things can actually generate a couple $100 a month. It's so crazy and they're low effort. You can get up and running that day. You can film your first YouTube video right after watching this. Just turn on your cell phone camera, upload it to YouTube. If you love baking, you can bake some cookies, post it on Facebook Marketplace. It's that easy to get started now because of the internet. There are other ways of doing this where you can scale up faster, be more aggressive in building side income or building your own business. But just to get started, I guarantee you there's something you're doing right now that you can leverage into more income. Then there's dividend income. The reason why I have that income generating portfolio now in my non-registered account primarily and a bit in my RRSP is because, like I said, I'm transitioning into retirement. So I'm scaling down other forms of income, which is primarily from marketing. I want to build a nice passive income stream through covered call ETF. So I'm building that up simultaneously to kind of maintain around $10,000 a month. I'm over that right now, but $10,000 is a sweet spot number I'm looking for every single month of stable, reliable income coming in. I also have a marketing agency. I started off as a consultant, so that was an issue of side income, freelance work in your field of experience. I worked for companies and I started consulting on the side. Then I became a full-time consultant. Then I created my own company. I just kept scaling up, and you can do something similar. When my income increased, I could invest more. My portfolio grew faster. My portfolio started exponentially growing faster when I started making exponentially more money. That was the bigger driver of portfolio growth. It wasn't me being a better stock picker. It wasn't the S&P 500 raising more that year. It was me legitimately just making more money in my day-to-day life. So I had more money to invest, me paying down my debt so my money wasn't getting tied up in other areas. I could just take what I earned, invest it after I'd paid down all the debt. That's all it is. So I really want to push home. Look around what you're doing in life. Is there anything you can monetize, anything you can make money off of, even if it's an extra $50 or $100? Start small, scale up. All right. So that's what we have. Here is the fixed order, same logic, no emotion. Every paycheck follows this structure. When money hits your account, it knows exactly where to go and why. First on those minimums, then into your debt and emergency, then into your living costs, then invest and grow. So number one, minimums, protect your baseline with automated minimum payments. Number two, living costs, fund daily life with a buffer or for friction-free spending. Number three, high interest debt plus emergency fund, eliminate expensive debt while building your safety net. Number four, TFSA, build tax-free wealth with consistent contributions. Number five, RRSP. Number six, income growth, develop multiple streams to accelerate everything. I honestly feel income growth can be done with number one. Pay off all your debt, figure out how to make more money. Make more money, you pay off debt faster. I just did those two things. I guess I could have just said that at the beginning of the video, but then I'd have no YouTube video for today. All right, leave your comments below. Download this at GaryGillX.com. Join the $1 million club. I made it $1, so I want it accessible to everybody. And the $1 stops scammers from joining. So you don't get these fake Garys reaching out to you to be like, hey, show me your bank account number. That happens when you make something free. I tried that on Discord. It was a mess. Now with the $1 million club, we have a $1 amount just to stop scammers from joining. So it's accessible for you. Get access to all these PDFs. You can talk directly with me. So come join $1 million club. So go to Gary GillX. You'll see the button when you see my portfolio. And subscribe. By the way, everyone, subscribe.